Hello, you're watching Smart Money. Welcome to it, where today we're not laying out the case for global diversification. I think the merit or the value proposition is pretty well understood. Instead, we're taking a look at how one goes about building a globally diversified portfolio, especially where there's no easy answer to the question, what's the best country to invest in right now? Joining me in conversation is Arin Ruttenberg. He's head of Brenthurst Wealth Sandton. Arin, I'm sure that's a question that gets thrown your way quite often. So I want to shift perspective right at the top. Why should investors be thinking globally instead of betting on one country or one region?
Hi, Alishia, and thank you so much for having me. So this is exactly what prompted me to write my article and to start speaking about this, because obviously I face clients every single day and I get asked the same question. As soon as things change in the market, whether it's the dollar becoming weaker, whether it's the US becoming a little bit an underperformer, if you want to call it, every year it gets harder to answer. What country is going to outperform the next country, and trying to predict which country will be the top or will become the top of the top of the charts is extremely difficult to predict. So investing doesn't need to be complicated, but it does need to be consistent. And in today's world, that means building portfolios that are globally diversified. And it's not really about anything other than keeping it simple. And because no single country consistently leads the pack, over the last decade, you've seen top performing country changes almost every year. From Brazil in 2016, Turkey in 2022, Egypt in 2024. These are countries that the average listener probably wouldn't even realize. So trying to predict which is the next winner is like trying to play roulette. You might get lucky once or twice, but over time, the odds are stacked against you. So global investing, as you've correctly said, being diversified spreads your risk, increases your chances of capturing upside whenever it happens, whether it's innovation in the US, or growth in Asia, or the resurgence of Europe like we're currently seeing. It's not about predicting. It's about being positioned everywhere so you don't have to.
Absolutely. And, I just want to reiterate some of those performances over the past decade. You alluded to them when it comes to the top performing countries and the fact that it's changed almost every year. If we blitz through some of the data, 2016, as you mentioned, Brazil was the standout performer. 2018, Qatar topped the charts. 2022, Turkey delivered surprise double-digit gains. 2023, Argentina. 24, Egypt's, posted one of the world's strongest performances as well. And then, like you say, year to date, Europe coming roaring back, right? So clearly, trying to predict which data will top the charts next is a losing game. The data speaking for itself. So, Arin, how does one go about beginning to plot out their global investment strategy, making sure that you're positioned to capture opportunity wherever and whenever it happens?
Very good question. And literally the most simple investor who doesn't have potentially exposure to, or isn't really looking at the wealth management side yet, that just wants to keep things simple, can literally follow one index. They can do it in a number of ways, or they can literally buy the index, and that's the All Country World Index. Now, the All Country World Index can literally be purchased locally. It's a locally domiciled but offshore index. It can be purchased directly offshore in dollars via Vanguard, via iShares. But the point is, it's known as the All Country World Index, or the ACWI, as the acronym goes by. And it's essentially one index that you can invest in that includes 45 countries and about 85% of the world's investable equity markets, covering developed and developing or emerging markets. So what makes it powerful is that it adjusts as the world changes. If India grows and it gets bigger, well, then the weighting within the ACWI gets bigger. If a market underperforms, it shrinks in relevance. You're not stock picking, you're not country picking, you're owning a whole investable world in one fund. And that's a huge benefit, especially for long-term investors. And you can sleep at night and you don't have to worry what country is going to outperform the next. It all takes place automatically. If India was the biggest country, like I mentioned before, and the biggest market, then the ACWI would just be the ACWI's weighting in India would be the biggest, and that would take a long time. But the point being is that you don't have to do anything.
Absolutely. And that reflective of the real economy, right? What's at play currently. So like you say, it rebalances according to what's happening at any given time. At the moment, having said all of that, there seems to be, Arin, quite a bit of concern amongst investors about being too exposed to the US, especially given Europe's stellar performance that we've seen so far. So what's your take on US exposure right now?
I love this question because it is exactly what prompted me to write the article, what prompted you guys to have me on this interview. And the crux of the matter is it's a fair concern, especially after a decade where US stocks, particularly in the tech sector, have dominated, but are now underperforming in 2025. And we've, even since last year, we've been getting questions about the US dollar. But now this year, it's because of the resurgence of Europe, like I mentioned, that we're getting questions about, well, is America or the US still a good place to invest? And it still holds the world's most valuable and innovative companies. Think about Apple, Microsoft, and Nvidia. That's why it's a big part of global indices. That's why it's a big part of the ACWI, the all country world. So by owning something like an ACWI means that you're around 40% of your portfolio is already outside of the US. So you've got exposure to Europe, you've got exposure to Japan, to China, to India, and more. That means when other regions outperform like Europe this year, you still benefit because you're not only holding the US. If you're concerned about too much US weight, well, you can blend more underweight US type of exposure. For example, I like to blend unit trusts and ETFs, so you can actually implement one of the guests you've had on your show, Sean Peace's Randmore Fund, who has an underweight towards the US value style approach, and therefore you've got global themes and you've balanced the portfolio in a way that you can try and follow the ACWI, but at the same time, you can again have exposure to other markets. Now, importantly, that I'd like to say that, like I've mentioned about innovation, this leads me to the dollar, because a big question is, as well as the dollar, what will make the dollar effectively not become the world's leading currency? And it's an important question. And I think it's still the world's currency. Oil and gold, etc., are priced in dollars, palladium, platinum prices going up. But another very important factor, which Warren Buffett speaks about, is never bet against the US, right? And owning the ACWI, you've already got exposure to the US. If the US shrinks, your investment shrinks. But the dollar itself is now going through a period where Donald Trump has now recently, as of yesterday, passed the Genius Act, which is an act from Congress to allow stablecoin issuance and stablecoin regulation. And I don't want to make it a crypto discussion, but it's more about understanding that with stablecoin regulation, the way a stablecoin works, when it's minted, it has to essentially buy $1. And one stablecoin, for example, will issue a US dollar, and those US dollars need to be invested. And when those US dollars are invested, they are effectively earning returns straight to the bottom line. So you need to purchase more treasuries, you need to purchase more US dollars, so the US dollar becomes more popular. And this is a $250 billion industry right now, in which David Sachs, the crypto czar and AI czar of the US, working under Trump, is basically saying it's going to become $1 trillion industry. So there's so much more growth for the US dollar to still undergo. And the Genius Act has just been passed. It needs to go through the House, be signed by Donald Trump. So that, therefore, again, linking this entire discussion to the US and the US dollar, there's no such thing as just worrying about the US dollar falling apart. Just be invested globally.
Arin, that said, with the MSCI USA large cap up close on 752% over the past decade, and then Egypt's EGX 30 up 2,250%. I mean, how exposed are you to Egypt? Because certainly outperformance over, nearly every developed market puts strong incentive on the table, but then you've got some of the risk metrics to keep in mind as well.
Well, Egypt is such a small part, and that's the whole point. It's impossible to go and decide to go and put money into Egypt, because imagine yourself sleeping at night thinking about this 10 years ago, that the US would have given you 7 times your money. $100,000 would have given you 7 $100,000. We're averaging here. Egypt would have given you, with $100,000, $2.2 million. I don't know about you, but my clients and myself wouldn't have slept at night. It's a small part of the portfolio, but it's taking more risk. It's also like investing in a small company within even a developed economy and thinking to yourself, well, it's undervalued. I think it's going to perform because of X, Y, and Z. You're taking more risk. You're getting the return, but you cannot foresee what the future holds. And again, for myself, I'm happy to compound decent long-term returns at roughly 10%, which is exactly what the MSCI World or All Country World Index has given you over the last 100 years in US dollars, then trying to outperform based on volatility metrics, which could really cause you to make very bad behavioral decisions, which is exactly why most investors do underperform, is because they worry about what's the next country or what's the headline that they've read and how that's going to affect the investment. So Egypt, small to answer your question, but you know what, if it did get bigger, then so it would automatically get bigger within the portfolio.
Yeah, absolutely. So bottom line, as we wrap this conversation up, your advice to the average investor on gaining global exposure without having to manage a complex portfolio that causes sleepless nights.
So it's easier than ever. You don't need 10 different accounts to follow every headline, or you don't have to follow every headline out of China or Europe, or, go and research countries or indices. You just need one ETF or one fund. You can get it in a unit trust version that rules the world. I prefer, again, blending unit trusts as well as ETFs to follow this all country world index, but that would come with a little bit more experience. The average investor just needs to buy one fund, and it allows you to follow that fund, sleeping at night, continuing with your day. And you know what, even the fact is, Alishia, if it feels overwhelming, this is exactly where qualified wealth manager can help. They can put the right building blocks together, aligned with your goals, your needs, without you needing to watch every market move. And look, it's important to understand that there are tax implications, there's structural issues that come with investing in ETFs versus unit trusts, and having succession planning is important. So I've mentioned investing in one fund that rules the world. I love that. But bear in mind that depending on your specific circumstances and needs, from estate planning and succession planning and tax, we haven't discussed the CITES tax issues of this, it can be worthwhile to get advice, especially if your portfolio is quite considerably large.
Well, Arin, let's leave it there. Thanks so much for having joined us on Smart Money today. Arin Ruttenberg is head of Brenthurst Wealth Sandton.